Chasing. We all love the idea of a trading algorithm working quietly in the background, generating passive income while we sleep. But live financial markets are messy, unpredictable, and rarely tolerate rigid systems for long. Enter the Waka EA. At a $2,800 price tag, its marketing leads with a verified 4.5-year track record showing smooth, stable equity growth. But recent user reviews tell a completely different story. Traders report sudden, massive account wipeouts and vanishing profits. So how do we reconcile this? Is the algorithm itself fatally flawed, or are individual users making critical mistakes with their settings? Past performance doesn't prevent future losses, because market volatility eventually finds the breaking point of any fixed logic. Dropping $2,800 to buy the software is actually the smallest financial hurdle. Waka operates on what's known as an advanced grid system. Grid strategies rely on having a large reserve of liquid capital sitting untouched in your account. That money has to stay there, dormant, acting as a shock absorber for when trades go off the rails. We are going to strip away the marketing promises and look at the exact mathematical mechanics and risks of deploying a grid strategy in a live market. Deploying this algorithm requires exposing thousands of dollars in base capital just to let this strategy function. In quiet, ranging markets, the EA is highly efficient. It opens a position, takes a small profit, and closes out quickly. This flowchart shows what happens when the market aggressively trends in the wrong direction. The initial trade falls into the red. Instead of cutting the loss, the EA doubles down. It opens a second, third, and fourth trade, progressively increasing the lot size. The goal is to drag the average entry price closer to the current market price. If the market makes even a minor reversal, the heavy volume of those new, larger trades allows the EA to close the entire basket in profit. The grid collapses and the system survives. But if a strong trend continues without a pullback, that grid expands exponentially. The larger trade sizes rapidly consume your available margin. This active, high-stress maneuvering requires deep pockets and constant vigilance. Grid trading prints those highly consistent small wins by intentionally exposing your account to severe, compounding downside risk. To prevent a total account blowout, the EA includes a critical safety feature, the maximum drawdown percent setting. You set a hard limit. If your floating losses hit 30% of your account, the algorithm automatically closes all open trades. While this saves you from hitting zero, it forces you to lock in the damage. A temporary paper loss instantly becomes a permanent 30% hole in your capital. Because the system generates returns through tiny, incremental wins, it will take months of flawless operation just to earn back the money lost on that single day. Protecting your base capital mathematically guarantees that you have to endure and accept severe, programmed setbacks. Your ability to survive those grid expansions depends heavily on your specific broker's leverage limits. If you are using a heavily regulated broker that caps leverage at 130, your buying power is severely restricted during a margin crunch. The developer explicitly warns that at 130 leverage, you need a minimum of $6,000 in your account, running on the absolute lowest risk setting, just to avoid a margin call during a standard grid expansion. And the logistics don't stop at capital. The EA requires a dedicated virtual private server, running 24 hours a day so it never misses a price tick or a critical news event. You also need a high-quality ECN broker to minimize spread and slippage when volatility spikes. Between managing margin, maintaining server uptime, and paying broker fees, operating the spot requires active oversight. The idea that this is a completely passive, hands-off investment falls apart under scrutiny. To decide if this tool makes sense for you, look at this quadrant chart. We are mapping your available capital against your emotional tolerance for risk. Down here in the bottom left, we have the beginner profile, trading with less than $6,000 and prone to panicking the moment a portfolio dips into the red. If this is you, avoid the Waka EA. The mathematical certainty of deep drawdowns will destroy both your peace of mind and your account balance. Up in the top right is the well-capitalized algorithmic trader, utilizing strict, pre-planned stop-loss rules. This trader has the financial buffer to absorb a 30% hit without flinching. They can use the EA as one component of a broader, diversified strategy,
knowing exactly what the worst-case scenario will cost them. Long-term survival with this software depends entirely upon your financial buffer and absolute emotional detachment, not the algorithm itself. Grid trading is the financial equivalent of picking up pennies in front of a steamroller. You collect a steady stream of small, easy wins right up until you have to dodge a massive hit. The software operates exactly as engineered, executing a high-risk mathematical strategy with total precision. The reviews detailing blown accounts are the result of the strategy's inherent tail risk meeting reality, often compounded by users who undercapitalized for that exact scenario. This robot is a capable probability engine. Your job is to decide if the $2,800 entry fee, plus the thousands in base capital, justifies the severe psychological and financial toll you will pay when the market inevitably turns against you.